Comes the money.
Here we go. Money talk.
Here comes the money.
All right, good afternoon, good evening, and good night, depending on where you're listening or watching from. Welcome, and thank you for coming along to another episode of...
Here comes the money. You
Yeah.
always wait for me on that one, don't you?
Yeah.
Sorry, Hov.
Guys, before we get into anything, general advice only. Don't go and implement any of this stuff without getting some proper advice, and Peter will
That's
always
my part,
correct
normally.
me. Yeah,
That's my part.
Yep.
But that's okay.
go
I
ahead,
got it.
Pete. Do you want to
No, you did it well. I mean,
clarify that one?
general information. I mean, obviously, we don't know your situation out there, so don't just take whatever we say and put it in place. Get some advice because we don't know if it's going to work for you.
Yeah, look, what we're going to talk about today is actually a very, very powerful and important topic, and it's called leverage.
The power of leverage.
Yeah, and look, I think, Pete, before we get into a leverage, it means different things for different people. I know we're talking about financial leverage, but, you know, you can leverage your time, which
Yep.
the word leverage means making something more powerful.
Yeah.
And using something more effective and more efficiently to get a better outcome.
Yep.
So you could leverage your time, you could leverage your position.
You can leverage other people's time.
Yeah, you can
Expertise.
by educating yourself, you're leveraging yourself and your power. And so, but when we talk financially, leverage is simply borrowing.
Using
borrowing
someone
money.
else's money,
Yeah, that's it.
basically. Whether it's the banks or someone else's, in most situations, it's obviously using the bank's money to assist you and build your wealth further.
Yeah, so I like to, leverage some tomato sauce on my sausage roll sometimes.
You can. You can. I don't know if it's the same thing, but,
But it's leverage is
Yeah.
making it better.
Exactly.
To me, it's a positive thing. The reason I say that, it's a bit of a joke, but a lot of people, when they hear borrowing,
Yeah.
it's like, borrowing debt, and debt means a bad thing to them.
Yeah.
Psychologically, because most people, the only debt they have is their mortgage, and that's the hard debt. Who helps you pay that? No one. The tax man holds one arm behind your back, and you've got to pay it with after-tax dollars, and then you've got to live and survive and bring up the kids and do all. So that debt, I don't want another debt.
Yeah.
But when we're talking about leverage, we're using that leverage, as investment leverage.
Yep.
You can go and leverage and buy a car, which is
Yeah.
a depreciating asset.
Correct.
And yes, it's a necessity, but we're not talking about go and borrow money and use it on things like, cars, boats, or caravans, because that's a lifestyle decision, but
Yep.
probably doesn't make much sense.
No.
As they say, boat stands for but only another 1,000. So we're not talking about stuff like that. We're talking about borrowing money to invest in good assets that are growing.
Yep.
And the
That
power
appreciate in
of that.
value and will give you more later, or pay you an
Absolutely.
income, or capital appreciation, or whatever it might be.
Yeah, so to get straight into it, if you looked at a scenario where, let's say that you're there, I'm there 20 years ago.
Yep.
We've both got 100 grand.
Yep. Well, look, this we've done some numbers prior to obviously getting ready for the episode, but basically, if we look at a very simple example and say I've got $100,000. Now, if we invest that $100,000 and we achieve a capital growth rate over the next 10 or 20 years of 5% on average. Now, some years will be bigger, some years will be
Very
obviously much lower
conservative.
than that.
That's very
It can be
conservative.
conservative. I believe the average of the share market's a lot higher than that over a 20-year period, and the same for the property market. I think it's a lot higher. than that too.
7.2%
Yeah.
on average, depending on what you look at RP data or which
Yep,
one.
yep.
But 7.2% over the last 40 years is
Okay.
property.
Yep.
Shares, I think we had a Vanguard poster up.
I think it was
in the
12
office,
or
Pete, was it?
9%, one of the two. It
I
was
always
up
say
at
9. I think I'm going to go 9 because, but the volatility. So this is over time. Don't look at the volatility. Just draw a line from the start to the end
Yep.
and divide that by the number of years.
Yep.
You'll get 9% on the shares, 7.2% on property.
Thereabouts, give or take.
So the share market does grow faster than property.
It does. Yeah,
So-
it does. Obviously, over time, it's shown that it does. It doesn't mean it's going to always do that, but at the moment, historically, it has.
So let's say that you put your 100 grand into shares and
Yeah.
I put my 100 into property.
Yeah, the difference is this. So if we use the return of 5% and we start with 100K, now that 100K at a return of 5%, which is that 100K is your money, your savings or equity or whatever it might be, 100K over 10 years grows to about $162,889.
And that's
over a
just,
10
you leave it in there, you don't touch it, and
Yeah.
you just let its interest come
Exactly.
back and grow on itself.
Just
Okay.
that 5% return on the 100K over a 10-year period, you would have 162,889. Over 20 years, it jumps to $265,329 at that 5% growth.
What about the cents, Pete? Have you got the cents there?
There was cents. Hovig told me to cut the cents out. He wasn't happy. I think that 265
All right, so
through 29 had 77 cents. You don't want to forget about those cents.
So the 100 became 265
Yeah,
over
correct.
20 years.
Exactly right. So
That's no leverage, no
No
nothing.
leverage.
You put your 100 grand in.
Yep.
whatever investment it was at 5%, it became
Exactly.
265 grand.
Exactly right. At that 5%.
That's okay. That sounds pretty
It's
good.
not bad. It's better than doing nothing.
Better than it being still worth 100 grand, or if
Yeah.
even worse, you left it in cash.
Exactly.
100 grand in 20 years ago is,
Well, it's
it's
a lot
probably
less.
worth 10 grand.
When you
today,
look at
yeah.
inflation and what the banks actually pay you to keep your money in the bank, you most likely have lost money.
20 years ago, you buy a house with 100 grand.
Yeah, well, I mean, times have changed slightly. slightly. So
And a Big Mac was also, I think,
where it
$3.
gets exciting is when you do bring in the leverage, as
Yeah.
we discussed earlier. So let's say you started with the same $100,000. That's your deposit for property or shares, whatever you do. It doesn't matter. We're going to use the same 5%, except now we're going to bring in 400K of borrowed money. So you've put in 20% with your 100K, and we've borrowed the other 80%.
Yeah, quite naturally. Yeah, if I had 100 grand, I was going to invest in, say,
Yeah.
property again. I'd
sometimes you can borrow-
some money and use
Yeah.
it as deposit.
Sometimes you can borrow more than 80%, but we're just using that as a very simple example, starting with 100K of your money as your initial investment, and you've borrowed the other 80%, which is 400K. So effectively, you've invested $500,000. Okay, that 400K is borrowed money using someone else's money. In this situation, you're probably using the bank's money. Okay, so you've invested $500,000. Now, at a 5% return, that 500K in 10 years is actually worth $814,447 in 10 years' time. Okay, over 20 years, it jumps to $1,326,648.
Wow.
Over 20 years.
Got over the 1 million, yeah.
You're over the $1 million.
Whereas
Started
the other one was going to be worth
$265,000.
265,000 versus 1.3 million.
over a 20-year period.
It was the same period. They're both 20 years.
It's a 5 times difference
Yeah.
on that sort of split with that sort of return rate, that sort of leverage rate. Now, obviously, it'll vary. If you achieve a higher return or you leverage higher or lower. But in that example, just a very simple example, just to show you the power of leverage, that is the
Very
difference.
powerful. Very powerful.
Very powerful.
And
It's basically life changing if you ask me.
Yeah.
Okay? If you look at it in one other way, if you look at it on the return on your initial investment, which is 100K, that's over that 20-year period, it's more than 13 times return on your initial investment. Okay,
with leverage.
with the leverage,
Whereas without leverage, it was only two
it's
and a half
only
times.
2.6 times if you want to be
That's
precise.
huge. That's huge.
Without the cents.
And coming back to what I was saying before, Peter, when people go, they hear leverage, they hear
Yeah.
debt, and they go, oh,
Yeah.
well, most people are scared of the cost of debt.
Yeah, correct.
That's what they're really scared of.
Yeah.
And can I afford it?
Yeah, what's this going to cost me? It's another 400K or whatever number
Yeah.
that you're
But
borrowing.
we're not saying to go and invest it, like I said before, in a
Yeah.
boat, a car, a caravan.
Yeah.
I said invest it into something that creates income,
Yep.
something that maybe even creates tax benefit.
Correct. Yeah.
And most times with shares, cash, property, they're the only three real investments
Yeah.
you've got. They're
Yeah.
the categories
And you're
without.
obviously not going to borrow to invest in cash. You're probably going to borrow to invest in property or shares. We find that most people, correct me if I'm wrong, they're probably most comfortable to borrow and invest in property because they know it, they feel it, they see it, it's secured, and the banks will just give you more money for it too. Let's be honest.
Yeah, and the
Yeah.
banks know that.
Yeah.
The banks know that it's a safer asset.
Yep.
That's why they do that.
Yep.
But also, excuse me, I'll turn that off. But also the volatility, and the reason the banks are more comfortable with property, and the reason why everyone is more comfortable is because
Yeah.
the volatility is
Yep.
less. I always say to people, if you look at the share market,
Yep.
it's sort of going up and down, up and down, up and down. Over the long term, it's growing faster.
Yeah.
But that little up and down, what I liken it to is if you're in a little speedboat and the steering wheel's the market, if you touch the steering wheel, the boat's going to turn.
Yep.
Now, the property market's got the same cycles, but they're slow, gentle, more predictable. But if I liken that to a speedboat, the property one's a big cruise ship. The captain turns the steering wheel, the boat doesn't
Yeah.
turn. Or your old Ford XC,
Yeah.
it does that too. You can't turn the steering wheel, it doesn't turn.
It does turn. It does turn.
And then but the point I'm trying to
Slower
make
than a normal car.
is when it goes in this direction,
Yeah.
it'll keep going. It'll grow for 3 or 4 or 5 years, and
Yeah.
it'll slow down and go for another one.
Yep.
So it's not necessarily the fact that the banks are,
Yeah.
it's because the property is more
Yep.
predictable. It's got less volatility,
More stable.
safer to leverage in.
Supply demand, they see that. And again, to Hovig's point, in terms of what it was getting to, yes, you're borrowing 400K. Yes, it is debt. But remembering investment, there's an income that comes and helps you pay for that. And there's also quite often tax benefits that will help you with that too. So your net cost to hold that debt, if you structure it correctly, could most likely be zero.
Yeah. Quite often, Peter,
Yeah.
I've done investments for people where we get to the bottom and we get the rent, the tax, all the outgoings, the rates, insurance, the interest.
Yep.
And it says, this gives you $20 a week.
Yep.
Right? It might have been negatively geared, but when you put the tax position, everything all together, it's got a positive cash flow of $20 a week. And I say, well, is that $20 a week going to, change your life?
Yep.
I said, what would you buy with $20 a week? and they're thinking about it. I go, we're not buying this for
Yeah.
$20 a week.
Correct.
That's just sitting there
Yeah.
and enables you to hold the property.
Correct.
It could be $0
Yeah.
a week. It doesn't matter
Yeah.
as long as we can hold that property.
Exactly.
And if we can hold over the long term,
Yep.
coming back to what you said, well, we've got a 13%,
Yeah,
a 13 times
Yeah, return on your
outcome
initial capital.
on our
yeah.
initial
Yeah,
investment.
exactly right.
So-
I've got one other just example to show you about the power of leverage. Let's say you stuck with the same 100K without any leverage. And let's say your return wasn't 5% now, it was 9%. Have a guess what the where you'd end up.
Well, it was 265
Yeah.
before. I think it's probably like 320.
It's a bit more than that, but it's still not that
At 9,
expressive.
oh, you almost doubled the
At
rate of
nine-
return,
almost,
didn't you?
yeah, almost
Yeah.
double. So if you look at that 9% over a 20-year period, I won't even bother looking at 10
I'm
years.
going to go
Let's just
445,000.
You're not far. Times
I
that
haven't seen the answer
initial
yet.
100K, it's actually 560K.
Damn.
You're still, and look, assuming you can achieve that, 9% consistently over a 20-year period,
Yeah.
which you might be able to.
Yeah.
The leverage position over that 20-year period was still more than double.
Yeah, absolutely. And look, we never say to people to put all their eggs in one basket anyway.
Correct.
We always say have a bit in here,
Yeah.
bit in here, bit in here,
Yeah.
bit in here.
Yeah.
But you've got to look at what's the anchor of your
Yeah.
portfolio. What's the safest thing you can do?
Yeah.
Let's have an anchor. Then let's have some satellite assets going.
Yeah.
Taking advantage of some of this volatility. Not necessarily. We don't look at day trading and
No,
things like that.
no, we don't.
Definitely. At least minimum 12-month investment terms.
Yeah.
And
and the rest. Yeah. When you get to shares and property, you're looking at 7 years plus. you
Yeah,
know?
well, when I'm talking, I mean, some of these ETFs and stuff,
Oh,
you
yeah,
guys
yeah,
jump
yeah.
in and out of.
Yeah, sometimes. Yeah, exactly right.
But again,
It's not
that's
that
just a
frequent.
minority part
Yeah,
of your portfolio.
exactly.
So,
Yeah.
look, what it comes back down to is I always do this to people, and they think I'm
He's
saying
not calling you a
loser.
loser. He's saying leverage.
Yeah, I spoke to a client the other day, and they had all of their assets pretty much paid off, but we didn't have quite enough in the super for retirement. And he said, "Oh, what can I do? What can I do?" He's paying a lot of tax, but run out of ideas basically.
Mm.
And I just went like this. This is what you're missing. He said, "What's that?" I said, "Leverage." Oh, so we've got
Yeah.
all this equity sitting here.
Yeah.
What's it doing for us? Nothing.
Exactly.
He thought, "Oh, if I use the equity, the house is going to fall down." No, it's not.
No, it's not. Well, if you do it, you got to do it right. But
Yeah.
I mean, it's there's
So,
the right way to do it.
Yeah, that's
Exactly.
one way to do it. The other way I explain to people in their super fund.
Yeah, that's another option.
The power of a self-managed super fund, probably
Yeah.
the biggest benefit is the power of the leverage.
Yeah, I think
The
so.
borrowing capacity,
Yeah.
the borrowing
And
ability.
it's not for. I mean, on that, it's not for everybody. But it can. We've seen it work very well.
And the way,
Yeah.
way I explain it is I say if you had $1 and it was earning 5%, you earned 5 cents.
Yeah.
If you get $1 and the bank gives you $1 and still invested at 5%, you made 10 cents.
Yep. Yep.
That's the end
It's
of
a
my
very
explanation.
simple way of explaining it. It's very true.
Yeah, so look,
Yeah.
that's the power of leverage.
Yeah.
It is an important aspect, I think, to anyone's strategy, and definitely needs to be considered.
Yeah.
Not suitable for everyone, of course,
Exactly.
but it's a tool that I think a lot of people need to look at.
Just on that, before we obviously wrap up, because I think we're getting close, but just to share a client win, just is one very simple example, recent review that I did with a client. And obviously, they've obviously put themselves in a good position. Mortgage debt was right down. They've invested a few years ago. And we just compared where they were last year to this year over a 12-month period. Now, sometimes we review clients more frequently than every 12 months, but it's minimum 12 months. Now, over that 12-month period, the investments that they invested in, and they had leverage included, they actually made an additional over that 12-month period. I think it was $265,000 or $270,000 in the space of 12 months.
Just not doing anything.
They actually earned more than they earned in their salaries over
Yeah.
that period of time.
That happens more often
It's
than
actually tax-free too. Keep that in mind because it's capital appreciation. Unless you sell it, then you pay
Yeah.
capital gains tax. But if you hold it, that's tax-free money you've just made.
Yep.
Next year, I don't know what's going to happen. Maybe it'll come back a bit. Maybe it'll keep going up. I think it'll keep appreciating, but nobody can guarantee that part. Point is, they gave themselves the option by starting sooner, and now they're reaping the benefits. The previous year was even higher than that, but this is just to show just a client win that we've seen that's included this sort of strategy within their overall strategy.
Yeah.
And what they've seen.
A key safety feature they've got built into their strategy is not just diversification of asset
Yep.
class, but also areas.
Yes.
So, you know how you said, well, that's if this one goes up, that one doesn't. Then, and it's sort of like a ladder. They
Yeah.
just keep climbing.
Yeah.
They've done really well. They've
No,
done really well.
Really well. And that's one. I mean, I think
They've
I'm
been
going to
with us
share
for
more
about
of this.
6 or 7 years.
Yeah,
7 years.
at least,
Oh, yeah.
at least, yeah. So, and that's So basically, that's just 1 year's outcome. Previous years have been higher. Look, some years have been flat, but I mean, the point is they started and they gave it time, and now they're reaping the benefits of that time and capital appreciation. And I'm going to try to share a client win like this in every episode because I
Okay.
think I've got one for every day, to be quite
Well, it
honest.
goes to prove that time in life
Yep.
is your most valuable commodity.
Keep going.
As a wise man once said, once you spend your money, you can always make some more. But once you spend your time, it's gone forever. And with that, we'll wrap up the episode. Another Here Comes the Money. That's Peter Koleski. I'm Hovig. As always, if you guys need anything, reach out. We do offer obligation-free
Yeah.
chats to anyone. It doesn't cost you anything.
Yep.
Quickly, we could tell you, hey, let's have a catch-up. Let's see if it's going to benefit you.
Yep.
If there's something that we can do at Smart Money. Obviously, there's all the different departments. It's hard to understand which one's
Yep.
going to help you, but sitting down and understanding where you are, then you get an approach going, yep, before you even take that first step, we'll be able to say, look, in our experience, we can
Yeah.
definitely do something.
And if we can't help you, we'll also tell you that.
Yeah, and we'll tell you how to get to in a position to get yourself into a position where you can get help.
Exactly.
So it's always a win. Guys, thanks again for listening in.
Thanks very much. Appreciate it. And if you're not ready sort of to have a chat with us, just give us a follow on our channels.
yeah.
And yeah, I
always
always like
forget that.
sharing that. So, you might learn something that will help you. And eventually you might want to have a chat with us.
Yep, and maybe leverage some tomato sauce on your sausage roll.
That's right. The
Thanks.
100K was a sausage. The tomato sauce was the bank's money leverage.
Thanks, gentlemen.